Good morning to everyone. I am Francesco Casarella, the Italian country manager of investing.com and the co-founder of colazioneawallstreet. Today, we have a very special guest. It's a pleasure to have Mr. howardmarks, co-founder and co-chairman of Oaktree Capital Management. Mr. Marks, thanks to join us.
It's a pleasure to be here, Francesco. I'm very happy to do so.
We are here today because some weeks ago went out in Italy your new book related to market cycle, and I have it here. Let me translate it in Italian. It is called Il Ciclo Economico e Quello Finanziario, published by Oepli, and I have a few questions on your new book.
Please, go ahead.
I will start with, obviously, with market cycle, because you often give the example in your memos and books of thinking at the market as a pendulum swinging from one extreme to another. On 5 occasions, you got it right at the extreme point in the cycle. But my question is, if in the extreme periods we can guess where we are, how can we do the same for the intermediate periods where it's more difficult?
Well, my answer is very simple, Francesco. You can't. It was when I was working on that book that I was speaking with my son, who is a very brilliant investor and my consultant. And I said to him, Andrew, I think over my career, I've got my predictions about right. And he says, yes, Dad. That's because you did it 5 times in 50 years. 5 times. Well, actually, starting in the first one was 2000. So 5 times in the last 24 years. The market was either so crazy high or so crazy low that the error was obvious. And that's what highs and lows are. They're errors. The market is making a mistake. People are buying too high or they're selling too low. And when you see that, sometimes if you have the perspective of history and if you have your emotions under control and your objective, sometimes you can figure it out and take advantage. And I have been able to do that, luckily. But if I had tried to do it 50 times, or 500 times, or 5,000 times, my level of correctness would have declined to a coin toss. And, what if I said, well, every day, in the last 26 years, there have been about, well, let's say 30,000, 40,000 work days. What if I had said every other day, I'm going to make a call, too high or too low? I would be right about half the time. So the point is, there's not always something smart to do in the markets or vis-a-vis the cycle. And you must restrict yourself. By the way, most people are not capable of making this call at all. And if they tried to do it in the last 26 years, they would never have been right. You see, I have been studying this diligently for 55 years. That's how long I've been working. And I am unemotional and I am objective and I do this for a living and I got it right. But the average person who hasn't that experience and has not that objectivity and emotionality and doesn't do it professionally, the average person will never get it right or rarely get it right. So most people should not expect to derive great success from cyclical timing. They should study it. They should understand why not. They should aspire to be able to do it after 30 or 40 or 50 years of learning, but nobody should expect to be able to do it without study and without experience.
Yeah, sure. And you always said that even that you don't believe in macro forecasts or that kind of things.
Well, you know, when we started Oaktree 29 years ago, we wrote out our investment philosophy, and there are 6 important tenets in our philosophy, one of which is that our investment decisions are not driven by macro forecasts.
Yeah.
It's very hard to get them right. And as I indicated, the opportunities to intelligently time the market don't come along very often. And forecasts are not right very often. Macro forecasts, economy and market, interest rates, currencies, commodity prices. Rarely do we have the opportunity to get them right. So rather, I think Oaktree does better, and all of the readers of the book will do better if they stick to making judgments about the micro, which is companies, industries, and securities. When you study these things and you attain a level of knowledge that other people don't have, you can get an advantage as an investor. But it's very hard to get an advantage in knowing the macro.
Sure, totally agree. And let me go through another question that is related to the fact that you have a long and very successful career into the investment world. And I wanted to mention a very important example that you quote in one of your memo, Fewer Losers or More Winners, about the General Mills pension fund that in 14 years always came in between the 27th and the 47th percentile, but in the old 14 years, they ranked in the 4th percentile. So my question is, how can we apply this approach for retail investors in their portfolios?
Well, you know, it's interesting because that experience was the subject of my first memo, which I wrote in October of 1990. So we're coming up on 35 years. And it was called The Route to Performance. And I told the story of the dinner, which you just described, with Dave Van Benscoten, who ran the pension fund at General Mills. And as you say, for every one of 14 years in a row, General Mills's equities were solidly in the second quartile, just above the middle, but never at the top. Steady, that's the key. And so if you know, if you're the layman, you think, well, it's always between 27 and 47. Where would you be for the long term? They say, well, it probably averages out to 37. No, 4th percentile. And the reason being that that most investors occasionally, we say in English, shoot themselves in the foot and have a terrible experience, which negates their long-term successes. And General Mills never had that. They were never below average. So over the long term, they were obviously extremely successful, not because they were great in individual years, but because they were always good and never terrible. By the way, the Financial Times of London runs an article every Saturday called Lunch with the FT. And they take somebody to lunch and then they write about it, and about the meal and about the restaurant and about the person. So in December of 22, they took me to lunch. Actually, I took them to lunch in my favorite Italian restaurant.
Okay.
Northern Italian, by the way. And we were sitting there having lunch, and I said to the reporter, I said, investing at Oaktree is like eating in this restaurant. Always good, sometimes great, never terrible. And if you think about it, that's a really good formula for success in life. It would be nice to always be great, but you can't always be great because random things happen in the environment, things that you couldn't predict, things that are bad for you or your strategy. Sometimes your strategy is in favor. Sometimes your strategy is out of favor. your asset class, sometimes in, sometimes out. You can't do great all the time. But if you can do good all the time, great on occasion when things are aligned for you and never terrible, then I think you can have one of the most successful long-term records. That's what I strive for. I think Oaktree has achieved it. I'm very proud of that. But we certainly don't hit home runs every year.
Yeah, sure. I'm totally agree with this kind of thinking. Let me go to another question that is very important related to the key advice that, for example, for investor and for you, what is in absolute the most important advice if you have to choose one to follow to be successful in investing? What would it be?
Well, of course, that's a bit of a trick question, isn't it? Because my first book, which I wrote in 2011, had the title, The Most Important Thing. And there are 21 chapters, and each chapter says the most important thing is, and then it's a different thing. Because in our world, there are many things that are important and essential. And it's like a brick in the wall. You can't take one brick out of the wall and expect it to stand up. So you've asked me, what is the most important thing in a world where many things are essential? But if I had to give one piece of advice, I can. And the piece of advice is that investors should invest and stay in the market and steady, not try what we call in basketball trick shots. Invest steadily for the long term.
Yeah.
Because, it's hard to frequently get the timing right. As I said earlier, there are infrequent opportunities to do something profound in terms of timing. Now, we talked about the pension. We talked about error and excess. So if you think about the cycle, what happens is things are going well, the economy is performing well, the company is profitable, the profits are growing, the reports are good, all good things. People get more and more and more and more excited. And while that happens, the stock prices are rising, going up, 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 based on the excitement. And as people get more excited, they buy more and more and more until we reach a top. And a top is a mistake. It's an error. It's an excess. And then things don't go as well anymore. They turn down. And now the economy is not performing so well. And the company earnings are declining. And they're reporting negative results. And the stock prices are falling. And now people get depressed and sad. And they become more likely to sell. And eventually we hit a bottom, which is what? It's an excess on the downside. And people sell out at the bottom. So this approach is obviously counterproductive. It's the opposite of what we should do. Most people are excited and buy high and depressed and sell low. What we really should do is buy low and sell high. So this leads to my most important piece of advice, which is invest. Great if you can start when you're young and you have many, many years of growth and compounding ahead of you, and hold. Don't try to be too smart. Understand the cycle, but don't succumb to it. And so buying and holding is a great thing in the long run. Now, there will be times when you'll say, oh, the market is down, I wish I had sold. Or there'll be times when the market rises and you'll say, I wish I had bought more. But most people aren't capable of doing that. They don't buy more when the market is down. They sell. They don't.
They do the opposite. They do the
exactly.
opposite.
They do the opposite. So buy, hold. If you think that you have the experience and expertise and objectivity that I described earlier, you could try to sell a little at the highs and buy a little at the lows. But you have to make sure that, as you say, you don't do the opposite and damage your results. So my best advice is buy and hold. By the way, the S&P index of 500 US stocks is up about 10% a year for the last century. And that was enough. If you put in a dollar 100 years ago, you'd have about $15,000 today. That's enough, right? We don't have to have more. So adding to the result through timing would be nice, but it's obviously not essential for success. It's like what we call icing on the cake. But get in the market. Don't get scared to get out. Hold long term. And I think that is the surest way to success. There are other ways to be more successful, but they are less certain. And by the way, my friend Charlie Munger, Warren Buffett's partner who recently passed away, had a great way of describing this. He said that market timing, getting out to avoid a decline, is a two-decision strategy, because you have to get out, and it's challenging to get out before the decline, but then you have to get back in, and you have to be smart enough to know when it's time to get back in. So you have to do two things right, and very few people can do that. Buy and hold. By the way, Bill Miller, who's a great investor, who beat the S&P average for 15 years in a row, which is an incredible feat, said it's time in the market, not timing the market, that is the most dependable route to wealth.
Yeah, it's like when, for example, Warren Buffett says investing is simple, but it's not easy, because at the end, everyone can buy and hold an ETF, an index fund, but the difficulty is that you have to hold. So this is maybe the most difficult part.
And to have the discipline to do so.
Yeah, sure. Totally agree. And let me go to the last question of this wonderful interview that is related, is specific to Italian investors, because the Italian investors are very particular, because they really love the real estate, they really love the Italian government bonds, the large cap stocks. They suffer a sort of home bias. How can we explain to them that there are so many different opportunities for the medium and long-term investor, obviously, and get them to think about the other asset classes as well?
Well, Francesco, that's a great question. Your question said the Italian investors love real estate and they love the government bonds.
Yeah.
Loving is an emotion. You must not invest with your heart. You must invest with your head. Now, throughout the world, the Italians are famous for their emotionality and for their love of great food, and the Ferrari car, and the gnocchi norcina, and all the great foods I love, and the fashion, Gianni Versace and Valentino and all these people. Investing is not about love. Investing is about hard-headed analysis. So let's say you decide to invest in stocks, and you said, I'm going to invest in the stocks of the companies I love. I'm going to invest in Ferrari and all the famous brands, etc. There's no reason to think that's going to be successful. Buy cars and clothes and food for enjoyment, and take an objective approach to investing. That's my advice. So, for example, if you're not a buy and hold person, if you want to try to find bargains and so forth, what you want to buy are the stocks where the price is low relative to the intrinsic value. Has nothing to do with love.
Okay.
And in fact, if you love a stock or a company or a product and everybody else loves it, chances are the price will be high, not low. And rather than buying a bargain, you'll buy something that's overpriced. So you may have said it as a figure of speech, what you love, but try to, first of all, be open-minded and learn about a lot of different asset classes, not just real estate and government bonds. and try to look for the bargains. Now, I've been very fortunate in my life because I found a bunch of things that everybody else hated. And it's the things that people hate that give rise to the bargains. And maybe I'll finish answering your question as follows.
It's like, for example, let me say, it's like a sort of contrarian approach.
Contrary to most people, that's right. There are two piles of securities. On this pile, you have the things that everybody knows about, understands, feels good about, is optimistic about, and feels are respectable by their peers. On this pile, you have a bunch of things that most people don't know about, don't like, find unattractive, are pessimistic about, and feel will bring them dishonor in their community. Which pile are the bargains on? The bargains are on this pile. And I'm not saying you should buy everything that's on this pile, but that's where you look. And so I started my career in '69, but in '78, I switched to high yield bonds, junk bonds, totally disrespected. '88, my partner Bruce Karsh and I went into distressed debt, bankrupt companies, or companies that most people thought would go bankrupt. In '98, we invested in emerging market equities at a time when Russia had a ruble devaluation and Southeast Asia had an economic crisis. So we invested in emerging market equities. And we did all these things when they were out of favor. And so you must understand that good investing is not a matter of the things you love, but it's a matter of the things that are cheaper than they should be. I hope that's helpful. I know it's complex, but hopefully my books will help people understand these concepts. You mentioned Warren Buffett said, simple but not easy. Charlie Munger, his partner, when I was just about to write my book, The Most Important Thing, he said to me, just remember, none of this is easy. Anybody who thinks it's easy is stupid. What we're trying to do is make money. More money than other people. How can it possibly be easy? It's highly competitive among intelligent, motivated people. Can't be easy. But we should try to do it nevertheless. In the market, steadily, unemotionally, objectively. And I hope that helps, Francesco. I hope the book helps.
Yeah, so thank you very much, Mr. Marks, because this is our all important advices, and that's been a pleasure to have you here, really. Thank you so much.
Thank you. Pleasure to speak with you too.
And let me repeat, just before ending the video, the title of the book, in Italian, obviously, is Il Ciclo Economico e Quello Finanziario. Thanks so much, and have a nice day.